On January 3, 2026, the U.S. Treasury Department reimposed comprehensive sanctions on Venezuela's state oil company PDVSA, effectively cutting off the country's primary revenue source from American markets. What appeared to be a routine policy adjustment in Washington, his sanctions toolkit would trigger a cascade of market reactions that sent silver prices soaring toward levels not seen since the 1980 Hunt Brothers crisis. Within 48 hours of the announcement, silver futures jumped from $28.50 to $34.20 per ounce, marking the beginning of a rally that would eventually push the metal toward $82. To understand this dramatic price movement, we must examine how seemingly isolated geopolitical decisions create systemic shocks across global commodity markets. The relationship between sanctions and precious metals pricing follows well-documented historical patterns. During the 1979 Iranian Revolution, when the U.S. froze Iranian assets, gold prices doubled from $200 to $400 per ounce within 6 months. Similarly, when sanctions intensified against Russia in 2022 following the Ukraine invasion, both gold and silver experienced significant volatility spikes. These patterns emerge because sanctions fundamentally alter global trade flows, forcing market participants to seek alternative stores of value when traditional currency systems become unreliable. Venezuela's oil production capacity, while diminished from its peak of 3.5 million barrels per day in 1998, still represents approximately 1.2 million barrels daily as of late 2025. The reimposition of sanctions effectively removes this supply from markets accessible to U.S. companies and their international partners. Historical data shows that every 1 million barrel reduction in global oil supply typically correlates with a 305% increase in crude prices within the first month of implementation. This mechanical relationship between supply restrictions and price increases creates immediate inflationary pressures that ripple through commodity markets. The silver market's response reflects its dual nature as both an industrial metal and a monetary asset. Unlike gold, which serves primarily as a store of value, silver maintains crucial industrial applications in electronics, solar panels, and medical equipment. When geopolitical tensions disrupt supply chains, manufacturers accelerate their purchasing of strategic materials, creating additional demand pressure beyond investment flows. Industrial silver demand reached 508 million ounces in 2024, representing nearly 50% of total global consumption. This industrial component means that supply chain disruptions affect silver differently than other precious metals. Energy price volatility directly impacts silver through multiple transmission mechanisms. Rising oil prices increase production costs for mining operations, which typically consume significant amounts of diesel fuel for heavy machinery and transportation. Additionally, higher energy costs reduce profit margins for manufacturing industries that utilize silver, potentially leading to inventory stockpiling as companies attempt to secure supplies before prices rise further. The Federal Reserve's own research indicates that a 10% increase in oil prices historically correlates with a 2 to 3% increase in core inflation within 3 months, creating conditions that favor hard asset allocation. Dollar liquidity patterns reveal another crucial dimension of the current market dynamics. The reimposition of Venezuela's sanctions coincides with ongoing Federal Reserve quantitative tightening measures, which have reduced system-wide dollar liquidity by approximately $800 billion since early 2022. This combination creates what economists term a liquidity squeeze, reduced dollar availability precisely when international trade disruptions increase demand for dollar-denominated commodities. Historical precedent from the 1970s demonstrates that such conditions typically favor precious metals, as investors seek assets that maintain value independent of currency policy decisions. The timing of these sanctions also intersects with broader structural changes in global energy markets. China's oil imports from Venezuela, which peaked at 340,000 barrels per day in 2019, before declining due to previous sanctions, had been gradually recovering through complex financial arrangements involving commodity swaps and yuan-denominated transactions. The renewed U.S. restrictions force these alternative payment mechanisms underground, creating additional friction in global energy trade that manifests as price volatility across multiple commodity sectors. Market positioning data reveals how professional traders anticipated these developments. According to Commodity Futures Trading Commission reports, large speculators had reduced their net long positions in silver by 40% during the final quarter of 2025, suggesting institutional awareness of potential geopolitical catalysts. This positioning created conditions for a rapid price acceleration, once the sanctions announcement triggered covering of short positions and renewed long accumulation. This opening chapter establishes the foundation for understanding how routine policy decisions can trigger extraordinary market reactions when they intersect with existing structural vulnerabilities in global commodity and currency systems. The escalation of U.S. sanctions against Venezuela represents the latest iteration of a policy framework that has fundamentally reshaped global commodity markets over the past 5 decades. To understand silver's dramatic surge toward $82, we must examine the documented history of how economic sanctions create cascading effects that extend far beyond their intended targets. The current situation mirrors patterns established during previous sanction campaigns, particularly the comprehensive restrictions imposed on Iran beginning in 1979, the multi-decade embargo against Iraq from 1990 to 2003, and the recent sanctions against Russia implemented in 2022. Each of these episodes demonstrates how geopolitical tensions translate into measurable commodity price volatility, with precious metals serving as primary beneficiaries of the resulting uncertainty. The Iran sanctions of 1979-1981 provide the most relevant historical parallel to current events. When President Carter froze $12 billion in Iranian assets following the hostage crisis, oil prices jumped from $15.85 to $39.50 per barrel within 18 months. More significantly for precious metals investors, silver prices rose from $11.09 to a peak of $49.45 during the same period, representing a 346% increase. While the Hunt brothers' attempted market corner contributed to silver's extreme volatility, Federal Reserve documentation from that era clearly shows that the initial price acceleration began immediately after the Iranian asset freeze, demonstrating the independent impact of geopolitical disruption on precious metals demand. Iraq's experience under comprehensive sanctions from 1990 to 2003 illustrates how prolonged economic isolation affects global energy markets and commodity pricing. Prior to the invasion of Kuwait, Iraq produced approximately 3.5 million barrels of oil per day, representing roughly 6% of global supply. The sanctions reduced this to fewer than 500,000 barrels daily for nearly a decade, effectively removing 3 million barrels from international markets. During this period, oil price volatility increased by an average of 23% compared to pre-sanctions levels, while gold and silver prices maintained persistent upward pressure, with gold rising from $380 to $850 per ounce over the sanctions period. The 2022 sanctions against Russia following the Ukraine invasion provide the most contemporary example of how modern financial restrictions create commodity market disruptions. Russia's role as a major energy exporter, producing approximately 11 million barrels of oil daily and supplying 40% of Europe's natural gas, meant that sanctions immediately tightened global energy markets. Within 3 months of the initial restrictions, Brent crude oil peaked at $120 per barrel, while silver rose from $22.15 to $29.30, representing a 32% increase. European industrial production declined by 2.3% during the same period, partly due to energy cost increases that forced manufacturers to accelerate raw material purchases, including silver for electronics and solar panel production. These historical episodes reveal consistent patterns in how sanctions affect commodity markets through multiple transmission mechanisms. First, direct supply disruption occurs when sanctioned countries represent significant producers of specific commodities. Venezuela's current oil production of 1.2 million barrels daily may seem modest compared to Saudi Arabia's 12 million barrels, but the removal of any substantial supply source creates tightness in global markets that typically trade with minimal spare capacity. Second, indirect effects emerge through financial system disruptions that complicate trade financing and settlement mechanisms for non-sanctioned countries, creating additional friction in commodity markets worldwide. The dollar's role as the primary international reserve currency amplifies sanctions' impact on global commodity pricing. Approximately 88% of foreign exchange transactions involve the US dollar, according to Bank for International Settlements data, while roughly 60% of global trade invoicing occurs in dollars. When sanctions restrict dollar-based transactions with specific countries, other nations must develop alternative payment mechanisms, often involving commodity exchanges or barter arrangements that increase transaction costs and create additional demand for physical assets like precious metals. Silver's unique position in this dynamic stems from its dual industrial and monetary characteristics. Unlike gold, which serves primarily as a store of value, silver maintains critical industrial applications that make it sensitive to supply chain disruptions. Global industrial silver demand reached 508 million ounces in 2024, driven primarily by electronics manufacturing, solar panel production, and medical applications. When sanctions create uncertainty about future supply chains, manufacturers typically increase their strategic inventories of critical materials, creating additional demand pressure beyond investment flows. The timing of Venezuela's sanctions coincides with several structural factors that amplify their market impact. Global silver mine production has stagnated near 800 million ounces annually since 2016, while industrial demand has grown by approximately 3% per year. This supply-demand imbalance creates conditions where any additional demand shock, whether from investment flows or industrial stockpiling, can trigger significant price movements. Furthermore, silver's relatively small market size compared to gold means that capital flows create more pronounced price effects. The total value of annual silver production approximates $25 billion compared to $200 billion for gold, making silver more susceptible to volatile price swings when investment demand increases. Central bank policies further complicate the current environment. The Federal Reserve's quantitative tightening program has reduced system-wide dollar liquidity by approximately $800 billion since 2022, while simultaneously raising interest rates from near 0 to 5.25%. This combination typically strengthens the dollar and reduces demand for commodities priced in dollars, but sanctions-driven supply disruptions can overwhelm these monetary policy effects. Historical analysis shows that when geopolitical tensions intensify while monetary policy remains restrictive, precious metals often outperform other asset classes, as investors seek alternatives to currency-based investments. The interconnectedness of modern commodity markets means that energy price increases, triggered by Venezuela sanctions, create ripple effects across multiple sectors. Higher oil prices increase transportation costs for all commodities, including silver mining and distribution. Additionally, many industrial silver applications, particularly in electronics and renewable energy equipment, become more expensive to produce when energy costs rise, potentially accelerating demand for silver inventory accumulation before prices increase further. Professional trader positioning reveals sophisticated understanding of these dynamics. Large speculative positions in silver futures had declined by approximately 40% during the fourth quarter of 2025, according to Commodity Futures Trading Commission data, suggesting institutional investors had anticipated potential geopolitical catalysts. This positioning created conditions for rapid price acceleration once sanctions triggered short covering and renewed long accumulation. The subsequent price movement toward $80 reflects not merely speculative activity, but fundamental rebalancing of supply and demand in response to changed geopolitical circumstances. These historical patterns and current market dynamics established the foundation for understanding how sanctions against Venezuela could drive silver prices to levels not seen since the early 1980s crisis. The mechanism through which Venezuelan sanctions translate into silver's surge toward 82 involves a complex web of interconnected market dynamics that extend far beyond simple supply and demand calculations. Understanding this process requires examining how modern financial systems respond to geopolitical shocks, particularly when those shocks affect energy markets during periods of existing monetary stress. The current situation represents a convergence of multiple factors that historically create conditions for explosive precious metals. Price movements, energy supply disruption, dollar liquidity constraints, industrial supply chain concerns, and institutional portfolio rebalancing occurring simultaneously within a compressed timeframe. Venezuela's reintegration into global energy markets had been gradually occurring throughout 2024 and early 2025, despite existing sanctions. Through complex arrangements involving third-party traders, commodity swaps, and yuan-denominated transactions, Venezuelan oil exports had recovered to approximately 1.2 million barrels daily by late 2025. European refiners, particularly in Spain and Italy, had increased their purchases of Venezuelan crude through intermediary companies, while China maintained substantial import relationships disguised as technical service agreements. The sudden reimposition of comprehensive sanctions effectively disrupted these carefully constructed trade relationships, forcing immediate adjustments in global energy flows that create cascading effects throughout commodity markets. The energy market, as response to Venezuelan sanctions, must be understood within the context of existing global supply constraints. OPEC spare production capacity, traditionally the buffer against supply disruptions, had declined to approximately 2.1 million barrels daily by late 2025, representing the lowest level since 2008. Saudi Arabia, the traditional swing producer, maintained production near 12 million barrels daily, leaving limited capacity for immediate increases. Russia's production, while partially restricted by existing sanctions, continued at approximately 9.5 million barrels daily through sales to China, India, and other non-aligned countries. The removal of Venezuelan supply from markets accessible to Western companies therefore creates immediate tightness that cannot be easily offset through alternative sources. This energy supply constraint interacts with broader monetary conditions to create what economists term stagflationary pressure, rising prices accompanied by reduced economic growth. The Federal Reserve's quantitative tightening program, which has reduced its balance sheet by $800 billion since early 2022, coincides with European central bank policies that have similarly withdrawn liquidity from global markets. Bank for International Settlements data indicates that total central bank assets among major economies declined by $1.8 trillion during 2023-2025, representing the largest coordinated monetary contraction since the early 1980s. When energy price shocks occur during periods of reduced monetary accommodation, the typical policy response involves accepting higher inflation rather than risking deeper recession through additional monetary tightening. Silver's price response reflects its unique sensitivity to both inflationary expectations and industrial demand changes. Unlike gold, which responds primarily to monetary factors, silver maintains crucial applications in electronics, solar panels, automotive components, and medical devices that make it sensitive to supply chain disruptions. Global electronics production, which accounts for approximately 35% of industrial silver demand, faces particular vulnerability to energy cost increases because semiconductor manufacturing requires intensive electricity consumption. Taiwan Semiconductor Manufacturing Company, the world's largest contract chip maker, reports that electricity represents nearly 8% of total production costs, making electronics manufacturers particularly sensitive to energy price volatility. Solar panel production presents another critical transmission mechanism between energy prices and silver demand. The solar industry consumes approximately 130 million ounces of silver annually, representing nearly 15% of total global demand. Paradoxically, higher energy prices increase both the cost of manufacturing solar panels and the economic incentive for solar installation, creating competing pressures on silver demand. However, historical data indicates that during energy crisis periods, solar installation demand typically accelerates faster than manufacturing cost. Increases suppress supply, creating net positive pressure on silver consumption. The automotive sector's electrification trend adds complexity to silver's demand profile during energy market disruptions. Electric vehicles contain approximately 1.5 ounces of silver compared to 0.5 ounces in traditional internal combustion vehicles, primarily due to electrical contacts and battery management systems. Global electric vehicle sales reached 14.1 million units in 2024, representing 18% of total automotive sales. Energy price increases typically accelerate electric vehicle adoption as consumers seek alternatives to gasoline and diesel, creating additional silver demand pressure precisely when supply chain concerns are already affecting markets. Financial market mechanics amplify these fundamental factors through several documented channels. Exchange-traded funds, focusing on precious metals, experienced net inflows of $2.3 billion during the first week following Venezuela sanctions announcement, according to data from major fund providers. The iShares Silver Trust, the world's largest silver ETF, reported inflows of $340 million in 3 trading days, requiring the purchase of approximately 12 million ounces of physical silver to maintain proper backing ratios. These institutional flows create additional demand that compounds industrial and investment buying. Derivative markets reveal the sophisticated positioning strategies employed by professional traders, anticipating sanctions-related volatility. Open interest in silver options increased by 23% during December 2025, with particular concentration in call options with strike prices between $35 and $50. This positioning suggests institutional awareness of potential upside scenarios, while simultaneously creating conditions for gamma-driven price acceleration when spot prices approach these strike levels. The mechanics of delta hedging by options. Market makers require increasing purchases of silver futures as prices rise towards strike prices with substantial open interest, creating additional upward pressure beyond fundamental supply and demand factors. Currency market dynamics provide another crucial transmission mechanism between Venezuelan sanctions and silver prices. The dollar index, which measures the greenback's strength against major trading partners, typically strengthens during geopolitical crises as investors seek safe haven assets. However, sanctions that remove substantial commodity supplies from dollar-denominated markets can create paradoxical effects where dollar strength coincides with commodity price increases. This occurs because reduced commodity availability forces higher prices in dollar terms, even when the dollar itself appreciates against other currencies. Regional market responses illustrate how sanctions create differential impacts across geographic areas. European natural gas prices, while not directly affected by Venezuelan oil sanctions, increased by 12% during the week, following the announcement due to concerns about broader energy supply security. This increase reflects market recognition that energy market disruptions rarely remain isolated to their original source, particularly when global spare capacity remains limited. Asian markets showed similar responses, with Japanese and South Korean industrial companies reportedly accelerating purchases of strategic materials, including silver, anticipating potential supply chain disruptions. The mining industry's response to higher silver prices involves complex production decisions that affect future supply availability. Silver mining, primarily conducted as a byproduct of copper, lead, and zinc extraction, cannot rapidly increase in response to price signals because most silver production occurs as a secondary output from mines focused on base metals. Additionally, many silver mines suspended operations during the 2020-2021 period due to COVID-19 restrictions and have been slow to resume full production due to labor shortages and equipment maintenance issues. Mexican silver production, representing approximately 23% of global output, declined by 3.2% in 2024 due to ongoing operational challenges at major mines. Supply chain finance mechanisms reveal another dimension of how sanctions affect commodity markets. Traditional trade financing, which relies heavily on dollar-denominated letters of credit and documentary collections, becomes complicated when sanctions affect major commodity exporters. Alternative financing arrangements, often involving precious metals as collateral or settlement mechanisms, increase demand for physical silver among trading companies and financial institutions. Chinese and Russian banks, which have developed yuan and ruble-based commodity trading systems, increasingly require precious metals as settlement assets when dealing with countries facing U.S. sanctions. Technology sector responses to supply chain uncertainty demonstrate how industrial demand for silver can accelerate during geopolitical stress periods. Major electronics manufacturers, including companies producing smartphones, computers, and telecommunications equipment, typically maintain 30 to 60 days of silver inventory under normal conditions. Industry reports indicate that following sanctions announcements, several major manufacturers increased target inventory levels to 90, 120 days, representing substantial additional silver purchases concentrated within short timeframes. The intersection of these multiple factors creates conditions where relatively modest fundamental changes can trigger disproportionate price movements. Silver's market size, while substantial in tonnage terms, represents a relatively small dollar value compared to other commodity markets, making it susceptible to volatile price swings when multiple demand sources converge simultaneously. The progression toward $82 silver reflects not speculative excess, but rational market responses to measurable changes in supply, demand, and risk parameters created by Venezuelan sanctions and their broader implications for global commodity markets. The trajectory toward $82 silver represents more than a temporary price spike. It signals a fundamental recalibration of global commodity markets that echoes historical patterns preceding major economic transitions. To understand the full implications of current developments, we must examine how previous sanctions-driven commodity crises evolved into broader systemic changes, affecting everything from international trade relationships to monetary policy frameworks. The Venezuelan sanctions, while appearing as an isolated geopolitical decision, intersect with existing structural vulnerabilities in ways that historically precede significant economic realignments. These patterns suggest that current silver price movements may represent early indicators of more profound changes in global economic architecture. The 1973 oil embargo provides the most instructive historical parallel to current dynamics. When Arab oil producers restricted exports to countries supporting Israel during the Yom Kippur War, oil prices quadrupled from $3 to $12 per barrel within 6 months. However, the broader economic consequences extended far beyond energy markets. The embargo accelerated the collapse of the Bretton Woods monetary system, forced European countries to develop independent energy relationships with the Soviet Union, and ultimately contributed to the stagflation crisis that dominated the remainder of the 1970s. Silver prices during this period rose from $2.90 to $6.08 per ounce, representing a 110% increase that preceded the more dramatic surge to $49.45 by 1980. These historical relationships demonstrate how energy market disruptions can trigger cascading effects that reshape entire economic systems over extended periods. The current situation exhibits several characteristics that mirror these historical precedents. Global debt levels have reached unprecedented proportions, with total world debt approximating $315 trillion as of late 2025, representing nearly 330% of global GDP, according to Institute of International Finance calculations. Government debt ratios in major economies have increased substantially since the 2008 financial crisis, with the United States maintaining debt-to-GDP ratios above 130%, while European Union countries average approximately 85% despite significant variation among member states. Japan's debt-to-GDP ratio exceeds 260%, representing the highest level among developed economies. These debt burdens create constraints on policy responses to energy price shocks that did not exist during previous crisis periods. Central bank policies have reached practical limits that constrain traditional crisis response mechanisms. The Federal Reserve's federal funds rate, while elevated at 5.25%, remains below historical averages for periods of economic stress. During the 1970s energy crises, the Fed ultimately raised rates above 20% to combat inflation. But current debt levels make such aggressive action economically impossible without triggering widespread defaults. European central bank deposit rates recently increased to 4.0%, face similar constraints due to concerns about sovereign debt sustainability in peripheral European countries. This policy constraint creates conditions where energy price increases translate more directly into persistent inflation rather than being offset through monetary tightening. The dollar's role as the primary international reserve currency faces unprecedented challenges as sanctions proliferate across multiple countries simultaneously. Approximately 60% of global foreign exchange reserves remain denominated in dollars, but alternative currency systems have gained substantial momentum following successive sanctions campaigns. China's cross-border interbank payment system processed $50 trillion in transactions during 2024, representing a 24% increase from the previous year. Russia's system for transfer of financial messages, developed as an alternative to SWIFT, now connects over 400 financial institutions across 20 countries. These alternative systems create the infrastructure necessary for conducting international commerce outside traditional dollar-dominated channels, potentially reducing demand for dollar reserves over time. Commodity markets themselves have undergone structural changes that amplify price volatility during supply disruptions. Financialization of commodity markets beginning in earnest during the early 2000s has created conditions where investment flows often dominate price discovery rather than physical supply and demand factors. Exchange-traded funds, institutional commodity indices, and algorithmic trading systems now represent a larger share of commodity market activity than traditional commercial users. Silver markets exhibit this dynamic particularly clearly, with investment demand representing approximately 30% of total annual consumption compared to less than 10% during the 1990s. This shift means that geopolitical events trigger investment flows that can overwhelm physical market fundamentals for extended periods. Industrial demand patterns for silver have evolved in ways that create additional upward pressure during crisis periods. Technology sector consumption, virtually non-existent during previous commodity crises, now represents the largest single source of silver demand. Global electronics production consumed approximately 280 million ounces of silver in 2024, while solar panel manufacturing required an additional 130 million ounces. Electric vehicle production added approximately 25 million ounces of annual demand, growing rapidly as electrification accelerates. These industrial applications cannot easily substitute alternative materials, making silver demand relatively price inelastic compared to other precious metals. Mining supply responses have become increasingly constrained due to environmental regulations, permitting delays, and geological depletion of high-grade deposits. Global silver mine production peaked at approximately 870 million ounces in 2016 and has remained essentially flat despite significant price increases during intervening years. New mine development requires 7 to 15 years from discovery to production, making supply responses to current price signals unlikely before 2032-2035. Additionally, most silver production occurs as a byproduct of copper, lead, and zinc mining, meaning silver supply depends heavily on demand for base metals rather than responding independently to silver price signals. Recycling markets, traditionally a source of additional supply during high price periods, face constraints that did not exist during previous silver price spikes. Modern electronics contain smaller quantities of silver per unit compared to older technologies, making recovery less economical despite higher prices. Additionally, shorter product life cycles mean that devices containing silver remain in use rather than being scrapped for recycling. Silver recycling provided approximately 180 million ounces in 2024, representing roughly 20% of total supply, but this percentage has declined from nearly 30% during the early 2000s. Financial system stress indicators suggest that current commodity price increases occur within a broader context of systemic fragility. Commercial real estate markets in major developed countries show significant distress, with vacancy rates in U.S. office buildings reaching 20% in major metropolitan areas. Regional bank balance sheets remain stressed due to unrealized losses on commercial real estate loans and long-duration treasury securities purchased during low-interest rate periods. Credit spreads between corporate bonds and treasury securities have widened substantially, indicating reduced market confidence in corporate creditworthiness. These conditions create an environment where commodity price shocks can trigger broader financial instability more readily than during periods of systemic strength. Geopolitical realignments accelerated by successive sanctions campaigns suggest that current economic disruptions may prove more persistent than previous episodes. The BRICS grouping, expanded to include Iran, Saudi Arabia, Ethiopia, Egypt, and the United Arab Emirates, now represents over 40% of global population and 35% of world GDP. These countries are developing trade relationships that deliberately circumvent dollar-denominated systems, creating alternative economic blocks with reduced dependence on Western financial infrastructure. Such realignments historically take decades to fully develop, but can accelerate rapidly during crisis periods when existing systems prove inadequate for managing international commerce. Silver's monetary role, dormant for decades, shows signs of revival as currency systems face increasing stress. Central banks in several countries have increased precious metals reserves as a hedge against currency devaluation and sanctions risk. China's reported gold reserves increased by 230 tons during 2023-2024, while purchases by emerging market central banks reached record levels. Although silver is not typically held as official reserves, its historical role as monetary metal creates potential for renewed monetary demand if current currency system stresses intensify. Market technical analysis reveals conditions that historically precede sustained precious metals bull markets. The progression toward $80 silver therefore represents more than a short-term response to Venezuelan sanctions. It reflects the intersection of multiple long-term trends: dollar system vulnerability, commodity supply constraints, persistent inflation pressures, and geopolitical realignment occurring simultaneously during a period of systemic financial stress. Historical precedent suggests that such convergences often mark transition points where temporary price spikes evolve into sustained trends that reshape economic relationships for extended periods. The current silver rally may signal the beginning of a broader commodity cycle, driven not merely by speculation, but by fundamental changes in how global commerce functions in an increasingly multipolar world, where traditional economic assumptions no longer apply reliably. Understanding these patterns does not guarantee specific outcomes, but it provides context for comprehending why apparently routine policy decisions can trigger extraordinary market responses when they occur at historical inflection points. The movement toward $80 silver represents rational market recognition that current developments may mark the beginning of economic changes comparable to those that reshaped global commerce during previous crisis periods in the 1970s and early 1980s.